Welcome back to this special show on the monetary policy statement that has been announced and the 0.25% hike that the Reserve Bank announced. I've been speaking with economists Mridul Saggar and Pranjul Bhandari and bankers and bond experts Ashish Parthasarthy and B. Prasanna. Ashish, Prasanna, I'm coming to you all in just a minute on this what seems a coordinated game. The tax on insurance guys, at the same time, a lending borrowing mechanism opened for them on the CCIL. I'm coming to that in just a minute. One word on the macro setup from Mridul. Mridul, what did you make of the real rate, the one that Pranjul referred to? Do you think the Reserve Bank will want to go over 2%? Or was it just a reference and they may perhaps stop when it is about, say, 1/4 or thereabouts?
So firstly, I'll clarify that I don't believe our star in India is like 1%. The real neutral rate cannot be 1% in a country like ours. It should be slightly higher, but anyway, that's an issue of calculations among various central banks. Everyone seems to have gone overboard on pulling down the R stars. Let me also clarify another thing. See, before this 25 basis point hike, the transmission was, to my mind, pretty incomplete. And I have been making that point that a weighted average term deposit rate, to me, that's the most relevant real rate to watch, more than the new real policy rate. And that was negative, which is now turning out to be positive after this 25 basis hike in December. But even if I assume that all 25 basis points are passed on nominal rates, and we take RBI's inflation rate as given, we would actually end up with something like 0.65 real positive policy, the deposit rates, three quarters down the line, which is not large. I mean, typically these have been around 3% real rates, the deposit rates in a long-term average. So I don't know what we are complaining about here. Think about the weighted average lending rates. They would still be well below the long-term averages.
Fair enough. Okay, if you're going to say the deposit rates have to be 3 percentage points above the inflation, bankers are going to get really blue, hot and cold. But Ashish, let me come to the borrowing, the program itself. You know, it's a good 15.5 lakh crore, much like last year. And this time, the insurance companies may not come for the simple reason that the guaranteed product is the one that has got that tax. The HNI will no longer perhaps be willing to have too many guaranteed insurance products. And if you don't get, I think last year they bought some 2 lakh crore, or last year, no, this year they bought about 2 lakh crore of bonds. Do you think without that, this borrowing can be that easy?
So, no, the borrowing the number looks large, but we have to also realize that we are obviously a growing economy, right? The notional growth rate would be upward of 10%. So the demand drivers for bonds would be banks, banking system, balance sheet growing. And we also need to understand that over this year, the surplus with banks would have come down, given what has happened with deposit rates and deposit growth and credit growth. Second is the provident and pension funds. Again, they are an increasing corpus, right? Given what we are given our demographics and given notional. Even insurance companies, if you've heard them, they've said it will impact possibly by 10 or 15%, right? And otherwise they would grow. So I don't think demand will be too much of an issue. At best, there could be something at the margin, but it's not going to be a big issue at all in terms of demand for government bonds. So
for the better part of this year, you wouldn't worry about yields, you're saying? You don't see them flying away?
I won't worry about it. I don't see it flying away. As I've said before, they should be in a range. There could be some, because of technical issues or because of some periods where possibly there is no demand in that 1 or 2 months. And, so those could be issues which, which we have always seen, but which has got managed either by OMOs or by auctions being cancelled, size reduced or something like that. So I don't think it's a big issue.
Okay. Prasanna, a similar question to you. I mean, are you also not that terribly worried about, insurance companies not coming and doing forward rate agreements with you, asking you to warehouse bonds for them? Secondly, this borrowing lending mechanism, at the press conference it became very clear it was intended for insurance companies. It will be in the CCIL. Will that have a bearing on the yield curve?
So I'll try to answer it very quickly since Ashish has given a very detailed reply, Lata. I think I would be slightly worried about the borrowing program, but not just because of, insurance companies potentially not coming to the extent they came. It's also because of the fact that when we are comparing gross borrowing and net borrowing, we are comparing it with this year and the next year. And then we are saying that there's a nominal GDP growth, so the entire economy is growing. However, you have to note that the beginning of the year, we had a huge surplus liquidity in the banking system, and that liquidity is now down almost to zero, maybe give or take a few lakhs of crores. So from that perspective, I think the banking system is going to operate in a liquidity neutral, marginal liquidity surplus kind of an environment. So to that extent, the marginal propensity to buy government bonds is going to be that much lesser. Second, more important thing is also that I would have probably assumed that if the peak to the rate hike cycle is very, very close, then maybe to some extent borrowing can go through much more easily. But after having seen what's happened today, where all the cards are now close to RBI's chest, it's quite possible that there is a little bit of uncertainty with respect to what's going to happen to short-end rates. So if short-end rates are also going to be under pressure because of the potential, let's say, one more rate hike, then it's quite possible that the rest of the yield curve can also, kind of drag up. And also remember that the SGL supply is going to be higher. All this can be compensated by, a global bond index inclusion, which unfortunately doesn't look like a real possibility at this point of time, maybe. Or could, in the second half of the year, open market operations might be required by the Reserve Bank of India. So I think
that was going to be my next question. That was going to be my next question. And actually, we are running out of time. So, Mridul, if you can keep it short, should we expect OMO or even a CRR cut?
Not really at this moment. So clearly, if situation changes, all policy options should be kept open. That's why I'm saying we have to be very nimble and flexible in times to come, but not immediately this time.
Okay. Can I have a rapid fire? All of you, please tell me what do you expect in the April policy? Hike or pause? Prasanna first.
Pause, Lata, but I can't rule out at 25.
No, one word. Pause. Ashish?
Pause.
Pause. Pranjul?
Pause and no change in stance.
Okay, thanks. Mridul?
Data dependent, maybe pause this time, but not that doesn't mean you need to raise every time.
Oh, that has to be like RBI. Very quickly, only for the bankers, rupee, Prasanna, what is the likely range? Any depreciation or appreciation?
So I think, Lata, it will be a depreciating bias, but of course, a lot depends upon when the Fed peaks. When the Fed peaks, you will see a dollar weakening. So INR can benefit at that time, but not immediately.
Okay. Ashish, 84?
82 to 84 broad range.
Oh, right. Okay, I will have to call it a day. Lots more questions, but I think it's been a relatively simple policy. Unexpected lines on hike and slightly unexpected perhaps on stance, completely close to the chest on what they will do next. Thank you very much, Ashish, Prasanna, Mridul and Pranjul for joining me. We wrap up on this special show.